REITs or real estate investment trusts are a popular investment amongst Canadians, not only for the monthly distributions, but also to be able to take part in Canada's skyrocketing real estate prices. I'm going to spend a few minutes breaking down what I think will happen to REIT stock prices and distributions in the near future. But before we get into that, if you're a beginner Canadian investor and you're just looking for some starting points or some guidance on investing or personal finance, download my free ebook. I'll leave a link in the description and in the comment section so you can get access and how to get started. I won't spend too much time breaking down REITs, but long story short, they own buildings, apartments, or warehouses and earn monthly rental income. Sure, they can flip their investments and make some money on selling the properties, but if you continue selling your property, you won't be able to earn rental income and you won't be able to fund your distributions. In Canada, REITs have to pay 100% of their taxable income in the form of distributions, whereas in the US, they have to pay 90%. That means cash flow is a sensitive issue. If you've been paying attention to the stock market and interest rates, rates have been increasing significantly. The higher the interest rate, the more you'll be paying out every month, the less cash you'll have to increase or to pay your distributions. If we look at some of the ratios of these two Canadian REITs, we can see they're pretty highly leveraged. Take a look at CAPREIT, which is an apartment rental. They have debt as over 50% of their cost and a super low interest rate across all their debt of 2.53%. That's very low. If we look at last year, the rate actually decreased. However, I think this will be the last quarter of decreasing interest rates for a few years. Every new acquisition, every new mortgage or financing renewal will come at a higher rate. I said this before, but high rates mean lower cash on hand for the property owner. You can't really pass on all the cost to your tenant. There's a certain point where all tenants won't be able to pay or won't be able to afford your rent, so you'll be forced to have a lower bottom line. If we look at Smart REIT, which is mainly retail rentals, they also have over 50% in debt to book value, which is fine, it's expected. Take a look at their rates, 3.09%, decreasing over the last 3 years. Again, I think this will be the last quarter that Smart REIT will report decreasing rates. Every new purchase will come at a much higher rate, reducing the amount of cash I have on hand, which might reduce the amount of distributions they'll be able to pay. I'm pretty frustrated since I've been reading reports of an analyst saying that rising rates will help REITs, but this makes zero sense. I can show you analyst reports saying lower interest rates will help REITs. So which one is it? The one where they pay less per month or the one where they pay more? I understand REITs over the last 15 years have been beating and outperforming inflation, but that doesn't mean REITs rise with inflation. Inflation is currently 6% in Canada and 8.6% in the US. REITs will not be able to keep up. Let's talk about another item. Rising interest rates mean the bonds or treasuries offered by the Canadian and US governments are increasing. The 10-year US treasury is over 3%. The 5-year Canadian bond yield is 3.23%. But what does this mean? How does this affect you? How does this affect REITs? The 3.23% is considered the risk-free rate. If you've invested in these bonds, you're earning 3.23% risk-free. As interest rates rise, so too will this yield, meaning you can earn more risk-free. Risk-free rate is important. It means if you were to invest in anything else that involves more risk, you'll need to earn a higher yield. Take a look at CAPREIT. Right now, it's paying 3.11%. Why would I invest in CAPREIT earning 3.1 where I can earn 3.23 risk-free? We can see this trend. Take a look at CAPREIT, down 20% in the first 6 months of 2022. In order for REITs to keep up, they either have to increase their distributions or the share price has to go down to make it worth it for investors to take the risk of investing. Personally, I would want at least 2% more per year over the risk-free rate. So if I were to invest in CAPREIT, I wouldn't do it unless it's 5% instead of its current 3%. Lastly, we're entering or we're already in a recession. For landlords, this means businesses going under and higher vacancy rates. Lack of tenant, higher vacancy, and potentially reducing rent to secure tenants results in lower cash on hand to pay their distributions. I'm not here raising the alarm and saying REITs will be going under, but REITs with 90% or higher AFFO payout ratio will be at risk of cutting their distributions. If we look at another REIT where I may or may not used to have worked for, First Capital, based in Toronto, their yield is 2.88%. That's even less than the risk-free government rate. Their stock price would have to decrease significantly, or they would need to double their interest rate to make it worth it for me to invest. I would be earning 3.23% risk-free. So if I were to take a risk of investing in another company, I would need Just personally, at least 2% higher. Then take a look at the last 5 years. They haven't even recovered to their pre-pandemic prices, whereas many other industries have recovered over a year ago. Before I end this video, full disclosure, I do currently work for a REIT in Toronto, and I've worked for or consulted for many other Canadian REITs, so I'm a little biased. I have a little more information. If you're interested in investing in REITs, be prepared for a volatile few years at least until interest rates settle or we come out of the upcoming recession. I don't even think we've entered it yet officially, but recessions last 15 to 18 months, so be prepared for a volatile next year and a half. Let me know if you have any questions. Thanks for watching and tune into the next one.